Monday, August 1st, 2022, Maneco 64, home of alternative economics and contrarian views. The Bank of England Monetary Policy Committee, or MPC, is meeting on Thursday to decide whether to raise rates by a quarter of a percentage point or half a percentage point. I want to talk about why I think our currency is in great danger of hyperinflating. And I'm not trying to be tragic or trying to create clickbait or anything. I've never really thought we'd be in this situation, and I've been following currencies markets for over 30 years, and I worked in the city, of course, for over 20 years, and I've also studied monetary history for the last 20 years. Yes, I did study international relations and economics at university, but most of the useful things I've learned about the system have been done through my own studies after finishing university. So we're going to look at that today and why I think, not just the UK, but all currencies around the world are in a perilous state. Before I start, though, I'd like to thank you again for another good month of growth of the channel. The subscribers are picking up quite nicely. And I'd like to thank all of you, the new subscribers, existing subscribers, for all your support and interest for this channel, or community, as some of you like to call it. And it is a community, I would say. So with that, let's look at what's happening this week in terms of the Bank of England. So I saw an article this morning in the FT. It says Bank of England considers biggest rate rise for more than 25 years. That should raise alarm bells, I would say, for you. It doesn't for me, because I've been banging on about this for over 10 years. The fact that the Bank of England and others like the Fed, the ECB, Bank of Japan, well, many others, have kept rates almost at zero for like a decade, despite the fact that prices have been rising, asset prices have been rising, the inflation has continued, they've kept doing QE. The problem now is that through the Cantillon effect, all that inflation they've created, and by inflation I mean the creation of currency and credit, because of their loose policy of zero rates, their loose policy of creating reserves out of thin air to buy government bonds, to keep government bond yields low so that people and investors buy riskier assets and drive down yields and create a lot of leveraging economy. That's coming to an end now. The Cantillon effect is making sure now that all that inflation is flowing into the basic necessities of life, especially food and energy. And that, in my opinion, is going to lead to a massive loss of confidence, not just in the currency, but we're already seeing loss of confidence in our leaders, our institutions, the mainstream press, academia, the medical profession, everything, economics profession. There's no more faith. People don't have any faith and confidence in these institutions anymore, especially the people that have looked into it, people who are critical thinkers. Unfortunately, the great majority of the public out there has no clue what's happening. And the hope, it seems, or for the general public, and this is transmitted through the press, through the politicians, through the mainstream economists, the hope is that this is just a little glitch because of COVID and the Ukraine war. But I've been warning about this even before the '08 crisis, especially after Bernanke made that famous helicopter speech in 2002. I knew the central banks were going to go full steam ahead in terms of money printing and zero rates, and they did. And they haven't stopped. And they're pretending now that they're tightening policy. But I'm going to show to you that the Bank of England is way behind, and there is no easy way out. And unfortunately, what that's going to result in is a rush out of the currency. And that's what a hyperinflation is, when people demand for that currency drops through the floor, and that's what it does. And the price of food and energy going up is going to force the public to really get ahead of the curve, and it's going to create shortages that we're already seeing. So here's an example of complacency. Let's go through this article very quickly here. And actually, before I start, I'd just like to show you where prices are, because prices are a reflection of inflation. They're a consequence of inflation. And consumer prices, and in the UK we have the retail prices as well, they're rising at double-digit rates. Yes, the CPI, they're saying that it's only rising at, I think, 9.4%. But even then, the government has adjusted those numbers, and that's why the Bank of England has fudged the CPI data on its inflation calculator. There's a note here from the Bank of England, and if you haven't watched my video about that, it's up in the cards. Have a watch that video and you see what I mean. But it says here, please note the estimates in the calculator from 1949 onwards have been updated and revised. CPI estimates from the ONS published in May 2022. So you can bet a lot of these numbers now, they're gonna, the CPI especially, ONS is of course a government office of statistics, national statistics. It's gonna make it look lower than it really is. So that number that came out, let's see when it was, for June, the CPI at 9.4, that in no way reflects the real rise in consumer prices. I would say the retail price index, which rose at 11.8, which is almost 12%, that's a better reflection. And even that is probably tinkered with. Let's quickly look at what's the difference between, the main difference between CPI and RPI. And the government started using CPI in the late 90s when they gave the Bank of England independence, and it's always been below the RPI. And now they've got a new one, CPIH, where they don't use house prices to measure the increase in housing prices. They use rental equivalents. They're doing it like in the US, owners rental equivalents, which is rubbish, really. Instead of using maybe the nationwide house prices, they use some number that they make up, which is not based on reality. So RPI includes mortgage interest payments. This means it is heavily influenced by house prices and interest rates. Well, I mean, with mortgage rates going up very quickly now, with people who took really low rate mortgages last year, their deals are coming due next year. It's going to hurt a lot of people. I spoke to a friend recently who has bought a lot of properties to rent out and is taking on mortgages. This person was telling me that one of her payments has gone from $500 a month to $800, and this is just now when interest rates are rising, not very sharply. So CPI measures takes no account of housing costs. So And it doesn't take account of council tax increases either. RPI does. So that's the situation. Which one do you really trust? But yeah, back to the article. It says Bank of England policymakers will be under pressure to step up the pace of monetary tightening when they meet this week, following the lead set by the ECB and Federal Reserve. So the debate here is whether they'll do 0.5% or 0.25%. Just the fact that there's a debate about this is just ridiculous. The Bank of England base rate has risen from 0.1 to 1.25, which is almost 10 times less than what it should be, or even more, if they really wanted to rein in rising prices. They have to stop the inflation of currency and credit. Right now, you can borrow at 1.25%, and you've got the RPI rising at almost 12%. If they really wanted to stop these pressures, price pressures, which they call inflationary pressures, they'd have to raise the base rate to 15%. But can you imagine what it would do to the economy? It would totally destroy it. And I don't know why they think that rates are going to, or CPI or prices are going to come back down, the rate of growth. It's this fallacy that the markets still have. Right here, for example, markets expect interest rates to peak nearly at nearly 3%. I mean, these people are mad. Can't they're going to be this forward interest rate in overnight index swap market is just a total sham. And these people are going to be, we're going to probably have to save these people again when the whole banking system collapses with all these instruments that they trade in the derivatives market. It makes no sense whatsoever. And that's what worries me, that they're not going to do enough. And actually, I have to give credit to Mervyn King, or Lord King, who was governor of the Bank of England from 2003 to 2013. He came out recently on Sky News, and he said this philosophy that the bankers and the City of London and the mainstream economists have of wishing inflation or CPI to drop just because they think it will, is the King Canute theory of inflation.
The question is, will it come down to 2% where it's supposed to be? And the argument of central banks essentially is, well, we're saying it will come down to 2%, so everyone will believe us, and so it will come down to 2%. Well, that's a very odd way of thinking about it. I call that the King Canute theory of inflation. You sit there and you command the forces of the economy to bring inflation down to 2%, irrespective of whether you're prepared to raise interest rates enough to achieve that.
The only way to fight inflation or rising prices is to really have real interest rates. Right now, real rates are still negative. I mean, we've got the RPI at 11.8 and the bank rate at 1.25. So it's more than 10% negative, which means when you borrow money, you're actually getting paid to borrow money. And of course, the reason they're doing that is that the UK government is up to here in debt. And the easiest way to write off the debt is to inflate it. And that's why you need to protect yourself. If you have any kind of savings in the bank, in the local currency, i.e. in British pounds or sterling, it's not going to be worth what it is today in 3, 5, 10 years time. It's going to be a fraction of what it's worth. It might still be 10,000 or 50,000 pounds, but it's going to buy you a fraction what it buys you today. And that's why I've been warning people about this. I'm not telling people to buy gold and silver, but that's what I have done, and it has worked well since 2002. And I think it's going to continue to work well. And I'm afraid they're playing with fire here, and we're going to see a collapse of sterling. Not that it hasn't been a gradual collapse since 1914. I mean, £1 used to be almost $5, and now we're near one, and the dollar itself has lost a lot. So yes, it will be interesting to watch what the MPC does. If they only raise by 25, that's like that just goes to show that they have no intention of reining in the inflation. Even if they do it by 50, there might be a temporary squeeze up in sterling versus the dollar, but it's only short-term noise, I would say. Eventually, the same will happen to all the major fiat currencies. I'm not just having a go at the Bank of England here, because the Fed and the ECB are doing the same thing. And the IMF is saying that the UK is behind the curve. But I would say the ECB is even more behind the curve, because they've got almost 10% CPI, and their rate is at 0, while the Bank of England one is at 1.25. So that's the way I see it. How do you prepare yourself for that? Very difficult, but I would say just being aware of what's happening will help you, and that's what I'm trying to do here. I don't have like the solution to everything. All I have is the view of what's happening, the historical link to what's going on now with what happened in the past. And I've been warning about inflation and hyperinflation for years, and many people poo-pooed that, said, oh, we've got danger of deflation. But no, I've been proven right, and I think I'll be proven right again about the currency collapse. So with that, let's quickly look at where the markets are this morning. It's 8:24 a.m. London time. We've got spot gold pretty much unchanged at 1765. High's been 67. The low's been 1758. Spot silver is down 15 cents at 2018. Low's been 2007. The high 2037. The Dow future is down 84. The NASDAQ future is down 26, and the S&P future is down 11. FTSE 100 index is up 18, 74.45. Eurostoxx 50 is up 6 points. To the currencies, sterling is unchanged virtually, 121.87. The euro is up slightly at 102.30. The dollar is down 0.75% versus the yen at 132.20. Dollar is down 0.1 versus the Swissy at 95.03. And the dollar is up slightly versus the yuan at 675.90. Let's quickly look at the dollar versus the ruble. Dollar is up 3.7% versus the ruble at 62.53. So yeah, the ruble has weakened in the last week or so, but of course it's still at a relatively strong position compared to where it was in at the outbreak of the war in the Ukraine. It got up to like 140. The dollar bought as much as 140. To the other currencies, we got the Aussie dollar up 0.25% at 70.08. The dollar is down, well, actually unchanged versus the Canadian dollar, 127.91. And the Kiwi dollar is up 0.2% at 63.04. To the general commodities, WTI crude is down 1%, 96.75. Brent is down 0.2%, 103.11. High grade copper is down slightly at 357, US nat gas is down 3.6% at 7.94. Quickly look at the Dutch nat gas futures. Well, that's up actually 6%, and it's back above 200. So that's not good news for Europe. Yes, aside from currency problems. Well, that's what happened when there's a currency collapse. People just lose faith and confidence in everything. Producers of real things, commodities, they rein back their production because they don't want to sell it for currency that is like worth nothing. And unfortunately, it's going to get worse and worse. It's going to be explained as rising prices. And it's going to be, they're going to give every excuse for it, like Brexit, COVID, Russia. Maybe next they're going to say it's because of the Taiwan conflict, whatever. They'll find something. But why do I point out to the fact that it isn't? Well, because people need to learn about what's really going on so that they're not fooled again in the future. That's my opinion. To finish off, quickly look at the 10-year yield or the U.S. Treasury market or bond market. It's pretty much unchanged this morning. It's at 2.65%, the 10-year. The 2-year is still around 289. So, yeah, the curve is still inverted by about, over 20 basis points. So, there you go. If you enjoyed this video, make sure you hit the like button. Please share far and wide. Think about subscribing to my channel if you haven't yet. And I wish you all a great start to the month and a great day. Take care. Bye.